Illicit funds, often derived from drug trafficking, corruption, or cyber fraud, must enter the legitimate financial system. This initial entry is the placement stage. Globally, the estimated volume of laundered money ranges from 2 to 5% of global gross domestic product, equating to trillions of dollars annually. Placement involves physically introducing cash into banks or non-financial institutions. Techniques include structuring deposits, often called smurfing, where multiple small transactions are executed just below the mandatory currency transaction reporting threshold, typically $10,000 in the United States. Alternatively, criminals convert bulk cash into high-value, easily transferable assets like precious metals, negotiable instruments, or chips at casinos. The primary goal is to separate the physical cash from its criminal origin, making the funds available for electronic transfer. This stage is the most vulnerable to detection due to the physical handling of large cash volumes and regulatory scrutiny of cash deposits. Beyond structuring, placement heavily utilizes cash-intensive businesses as fronts. Restaurants, car washes, or vending machine operations are ideal because they naturally generate high volumes of cash receipts, allowing illicit funds to be commingled with legitimate revenue. This process is known as mixing. Another common method involves utilizing money service businesses, such as remittance companies, to convert cash into electronic transfers, often exploiting weak know-your-customer protocols in corresponding banking relationships. Cross-border bulk cash smuggling physically transports currency to jurisdictions with weaker anti-money laundering controls, often utilizing trade-based money laundering schemes, where goods are intentionally mispriced. Financial institutions detect placement primarily through currency transaction reports and suspicious activity reports, triggered by unusual deposit patterns or rapid fund movement inconsistent with the client's profile and declared business activity. Once the funds are placed, the next critical stage is layering. The objective of layering is to separate the funds from their source through complex financial transactions, making the audit trail nearly impossible to follow. This stage involves creating multiple layers of transactions to obscure ownership and origin. Layering often begins with rapid, high-volume wire transfers between various accounts and jurisdictions, particularly those with strict bank secrecy laws or opaque corporate registries. Criminals frequently utilize shell corporations and trusts established in offshore financial centers to hold the funds. These entities serve no legitimate business purpose, but exist solely to act as legal owners, shielding the beneficial owner's identity. The use of complex financial instruments, such as derivatives or life insurance policies, further complicates the tracing process by converting liquid assets into less transparent forms. Trade-based money laundering is a powerful layering technique. This involves misrepresenting the price, quantity, or quality of imports or exports. For example, over-invoicing goods allows the launderer to move excess value legally across borders under the guise of payment for trade. Another technique is the use of back-to-back loans, where the illicit funds are deposited as collateral for a loan taken out from a different institution, effectively queening the money by replacing it with a legitimate debt instrument. Digital assets, including cryptocurrencies, are increasingly used for layering, utilizing decentralized exchanges and mixers to break the transactional link between the sender and receiver. However, the immutable nature of public ledgers means that once the beneficial owner is identified, the entire chain of transactions becomes visible to law enforcement.
The final stage is integration. This is where the laundered funds re-enter the economy, appearing fully legitimate. The goal is to provide a plausible, verifiable explanation for the sudden accumulation of wealth. Integration is successful when the funds can be used without suspicion, effectively completing the cycle, making the money indistinguishable from legitimately earned capital. Common integration methods involve investing in high-value assets that appreciate, such as commercial real estate or fine art, which can later be sold, generating clean proceeds. Another technique involves the purchase of legitimate businesses that require significant capital investment but generate low returns, such as large farms or manufacturing plants, allowing the criminal to draw a salary or declare dividends derived from the laundered principal. Integration often relies on professional facilitators, including lawyers, accountants, and real estate agents, who provide the necessary documentation and legal cover. The purchase of commercial real estate is particularly attractive because it offers stability and often requires less scrutiny regarding the source of funds compared to direct bank transfers, especially when purchased through layers of anonymous shell companies. Another method involves utilizing casinos or gaming establishments where large winnings can be fabricated and documented as legitimate income. The legal risk during integration shifts from transaction tracing to proving the criminal origin of the assets themselves, often requiring complex civil forfeiture actions by governments under statutes like the Bank Secrecy Act. Successful integration means the criminal can now openly use the funds for personal consumption or reinvestment into the criminal enterprise, perpetuating the cycle. The primary regulatory defense against money laundering is the Anti-Money Laundering Framework, mandated globally by organizations like the Financial Action Task Force. In the United States, the Bank Secrecy Act requires financial institutions to maintain records and report suspicious activity via suspicious activity reports. Know Your Customer protocols are foundational, requiring verification of client identity, beneficial ownership, and understanding the expected nature of their business activities. Enhanced due diligence is mandatory for high-risk clients, such as politically exposed persons or those operating in high-risk jurisdictions, demanding deeper scrutiny of source of wealth and source of funds. Failure to comply results in massive financial penalties, often reaching billions of dollars for major international banks, demonstrating the seriousness of regulatory enforcement and the liability of compliance officers. Technology plays a crucial role in detecting the three stages. Transaction monitoring systems utilize artificial intelligence and machine learning algorithms to analyze millions of daily transactions, flagging deviations from established baseline behavior. These systems look for patterns indicative of smurfing during placement, rapid cross-jurisdictional transfers during layering, and large unexplained asset purchases during integration. Behavioral biometrics are increasingly used in digital banking to detect account takeover attempts often associated with layering. RegTech solutions automate compliance tasks, reducing human error and increasing efficiency in filing regulatory reports, particularly concerning sanction screening and adverse media checks. Blockchain analytics tools are now essential for tracing funds across decentralized ledgers, de-anonymizing wallets linked to illicit activity by analyzing transaction clusters and timing, providing crucial evidence for prosecution. The consequences of successful money laundering extend far beyond financial crime. It destabilizes legitimate economies by distorting asset prices, particularly in real estate markets, and funding organized crime and terrorism globally. For financial institutions, the penalties include not only massive fines, but also the loss of corresponding banking licenses, effectively cutting them off from the global financial system. The reputational damage associated with anti-money laundering failures can destroy public trust and shareholder value instantly. Effective compliance requires continuous adaptation to evolving criminal methodologies, ensuring that the regulatory framework remains robust against new placement, layering, and integration techniques, especially those exploiting emerging digital finance platforms. Understanding these three stages is fundamental to protecting the integrity of global commerce.